Good morning and welcome to today's currency market report. I'm bringing you the latest movements from the foreign exchange markets, where we're seeing significant volatility across major currency pairs as traders react to economic data, central bank signals and shifting global dynamics. The dollar's dominance. Let's start with the star performer of today's session, the US dollar. The greenback has surged to fresh multi-week highs against a basket of major currencies, with the dollar index climbing 0.8% to reach 109.2. This rally has been fueled by several factors working in concert. First, stronger than expected retail sales. Data released yesterday showed American consumers remain resilient despite elevated interest rates. Second, Federal Reserve officials have been signaling that they're in no rush to cut rates, with Governor Michelle Bowman stating overnight that inflation remains uncomfortably above the 2% target. This hawkish stance has pushed Treasury yields higher, making dollar-denominated assets more attractive to international investors. The dollar's strength is also being supported by its traditional safe haven status. With geopolitical tensions simmering in multiple regions and uncertainty about global growth prospects, investors are flocking to the perceived safety of U.S. assets. The yen's decline. On the losing side of today's equation we have the Japanese yen, which has fallen sharply against the dollar. The USD-JPY pair has jumped 1,2% to reach 149.85, dangerously close to the psychologically important 150 level that has historically triggered intervention from Japanese authorities. The yen's weakness stems from the Bank of Japan's continued ultra-loose monetary policy stance. While other central banks have been raising rates aggressively to combat inflation, the BOJ has maintained its negative interest rate policy and yield curve control measures. This divergence in monetary policy has created a significant interest rate differential that heavily favors the dollar. Governor Katsuo Uda's recent comments suggesting that the BOJ will maintain its accommodative stance, for the time being, have given traders the green light to continue selling the yen. Japanese officials have issued verbal warnings about excessive volatility, but without concrete action. These warnings have done little to stem the yen's slide. The weak yen is a double-edged sword for Japan. While it boosts the competitiveness of Japanese exports, it also makes imports more expensive, particularly energy, which Japan relies heavily upon. This could further complicate the BOJ's inflation management efforts. The euro stagnates. The euro has also had a difficult day, falling 0.6% against the dollar to trade at 1,0820. This marks a 3-month low for the single currency, which has been under pressure from multiple directions. Economic data from the Eurozone continues to disappoint. Germany, the bloc's largest economy, released industrial production figures this morning that showed a steeper than expected contraction of 1.8%. Month-over-month manufacturing surveys across the region have been consistently pointing to contraction, raising concerns about the Eurozone slipping into recession. The European Central Bank finds itself in a difficult position. While inflation has come down from its peaks, it remains above target, limiting the ECB's ability to provide stimulus. ECB President Christine Lagarde has been walking a tightrope, trying to balance the need to keep inflation under control while not crushing the already fragile economic recovery. Political uncertainty is also weighing on the euro. Ongoing debates about fiscal policy, energy security and structural reforms within the European Union have created an atmosphere of uncertainty that currency traders dislike. The pound's mixed performance. The British pound is showing more resilience than its European counterpart, but is still down against the dollar. Cable, as the GBP-USD pair is known, has fallen 0.4% to 1,2650, though it's managed to gain ground against the euro. The UK economy has been showing surprising resilience, with employment figures remaining robust and wage growth elevated. However, this strength is a mixed blessing, as it's keeping inflationary pressures alive and preventing the Bank of England from cutting rates as quickly as markets had hoped. Bank of England Governor Andrew Bailey struck a cautious tone in recent remarks, suggesting that, while the direction of travel for interest rates is downward, the central bank needs to move carefully to ensure inflation doesn't become entrenched. This relatively hawkish stance has provided some support for sterling, though the dollar's broad strength has still pushed the pound. Lower emerging market currencies under pressure. It's not just the major currencies feeling the heat. Emerging market currencies are also taking a beating as the dollar rallies and risk appetite diminishes. The Turkish lira has fallen to fresh record lows, despite the central bank's efforts to stabilize the currency through aggressive rate hikes. The Brazilian real is down 1.1% as concerns about fiscal policy and political uncertainty weigh on sentiment. The South African rand has dropped 0.9%, pressured by power supply issues and global growth concerns. The strong dollar creates particular challenges for emerging markets, many of which have dollar-denominated debt. As their currencies weaken, servicing this debt becomes more expensive, potentially creating financial stress. The Swiss franc and safe havens. Interestingly, the Swiss franc, another traditional safe haven currency, has shown relative strength today. While it's still down against the surging dollar, falling just 0.3%, it's gained against the euro and yen. The USD-CHF pair is trading at 0.8920. The Swiss National Bank has been less aggressive than other central banks in adjusting its monetary policy, but Switzerland's reputation for stability and its strong financial system continue to attract flows during periods of uncertainty. Gold, often considered a currency in its own right, has fallen 0.7% to $2.015 per ounce. Pressured by the strong dollar and rising treasury yields, which increase the opportunity cost of holding non-yielding assets, commodity currencies feel the pinch. The commodity-linked currencies of Australia, Canada and New Zealand are also under pressure. Today, the Australian dollar has fallen 0.7% against the US dollar to 0.6420, weighed down by concerns about Chinese economic growth and falling commodity prices. The Canadian dollar has dropped 0.5% to 1.3780 per US dollar. Despite relatively stable oil prices, traders are pricing in the possibility of more aggressive rate cuts from the Bank of Canada, as the country's economy shows signs of cooling. The New Zealand dollar, or Kiwi, has declined 0.8% to 0.5890 against the greenback, making it one of today's worst performers among developed market currencies. Cryptocurrency markets in the digital currency space. Bitcoin has fallen 2.3% to $41,200, while Ethereum is down 2.8%. The crypto markets often move in tandem with risk sentiment, and today's flight to safety in traditional currencies is pulling digital assets lower. Looking ahead. So what's next for currency markets? Several key events could drive further volatility in the coming days and weeks. Central bank decisions will be crucial. Any shift in tone from the Federal Reserve Bank of Japan or European Central Bank could trigger significant currency movements. Economic data releases, particularly US inflation figures and Eurozone growth indicators, will be closely watched. Geopolitical developments remain a wild card. Any escalation in international tensions could drive further safe haven flows into the dollar and yen, while any positive developments could trigger a reversal. Technical levels are also important. The USD-JPY pair's approach to 150, the euro's test of support at 1.08, and the dollar index's potential breakout above 110 are all levels set TRDR perspectives. Currency strategists at major banks are largely aligned in expecting the dollar to remain supported in the near term. Goldman Sachs has raised its year-end target for the dollar index to 112, while JP Morgan suggests the euro could fall to 1.05 if Eurozone data continues to disappoint. However, some analysts caution that the dollar's rally may be getting overextended. They point to positioning data showing that speculative traders are heavily long dollars, which could set up for a sharp reversal if sentiment shifts. Implications for business and travelers. For businesses engaged in international trade, today's currency movements have significant implications. Importers in Japan and Europe are facing higher costs for goods purchased in dollars, while US importers are benefiting from increased purchasing power abroad. For travelers, Americans will find their dollars stretch further in Europe, Japan and most emerging markets, while foreign visitors to the United States will face a more expensive trip. Closing thoughts. Today's currency market action underscores the complex interplay of economic data, central bank policy and global risk sentiment that drives foreign exchange rates. The dollar's surge reflects both U.S. economic resilience and global uncertainty, while the yen and euro's declines highlight the challenges facing the Bank of Japan and European Central Bank. As we move forward, currency markets will continue to serve as a real-time barometer of global economic health and investor sentiment. With central banks at different points in their policy cycles and significant uncertainty about the global economic outlook, volatility is likely to remain elevated for traders, investors and businesses alike. Staying informed about these currency movements and understanding their underlying drivers will be crucial for navigating the challenging environment ahead. That's all for today's currency market report. Stay tuned for updates, as these dynamic markets continue to evolve throughout the trading day.